Why is commercial real estate such a good industry to be a part of? The answer is because if you're an investor, it is the ideal investment. And you want to be part of the industry that is the ideal investment. And ideal is actually an acronym. And I learned about this acronym actually by watching YouTube videos. I.D.E.A.L. Income, depreciation, equity, appreciation, and leverage. And when you look at the other types of asset types which you can invest in, no other major investment vehicle has all five of these really powerful forces working together simultaneously. You can look at stocks, bonds, commodities such as oil and gold, and even cryptocurrency. And if you compare them side by side, not all of them have all five, which is your income, depreciation, equity, appreciation, and leverage working together. So there's a reason why real estate has created so many millionaires. I am going to explain each letter of this acronym through the lens of owning shopping centers. Income. I get cash flow through my tenants paying rent as an owner of a shopping center, commercial real estate. And when we buy properties at an 8% cap rate or a 9% cap rate even, sometimes even higher, but sometimes lower, that cap rate is an indication of how much income that you're going to get. And if you don't know what cap rate is, I can explain it in three different ways on a high level. The first way is that a cap rate is essentially the inverse of your price to earnings. If you're investing in stocks, you know price to earnings ratios. The cap rate is the inverse of that. Instead of companies being valued by dividing their market cap by their earnings, price to earnings, it is the NOI divided by the value of the property. So it's earnings or income divided by price, valuation of the property. It is also the unlevered yield at the moment in time that you're analyzing it. It's a snapshot. If you bought it all cash without taking into consideration debt or cash reserves or the transaction costs, what would you make on the deal percentage? What yield would you make? So there's the unlevered yield. And by the way, most homes in South Florida, I'm located in South Florida. And when you look at most residential homes in South Florida and you do this calculation, and very few people do it. My wife is a realtor and I showed her how we evaluate property. So she does use that with some of her investors that are looking to buy fourplexes, duplexes, and homes to rent out. So she knows about that now. But when you do this calculation on a lot of residential homes, I never see it more than 5% cap rate. I mean, sometimes I see it as a 1% cap rate, which is kind of crazy. And they're really betting on the appreciation and they're not really focused on the yield. But that's a tangent. The third way to explain the cap rate is that it does help you compare it to alternative investments. So if I'm looking at a McDonald's or a strip center that's a 6.5% cap rate, and I say, hey, do I want to put my money there, or do I want to put my money in a municipal bond, or do I want to put money in a treasury, or even any other type of investment vehicle? I can at least try to compare apples to apples a little bit. So that's income. The depreciation part, in the 1980s, there was an act that was passed which allows for people that own investment properties or any real estate that they're using to for business to depreciate that asset over a certain period of time. For commercial assets, it's 39 years, straight line depreciation. But a lot of times you're able to accelerate the depreciation by using cost segregation, meaning that you can get a lot more of that depreciation the first few years instead of having to wait 39 years for all of it. Now, that depreciation is a paper loss, which means that it's possible for you to receive positive cash flow through owning the real estate, but also at the same time, when it comes to reporting your income to taxes, you're actually showing a loss. So positive cash flow dividends paid to you, but at the same time, you may show a loss that can offset your other income. That is one of the main reasons why car washes are so popular today as an investment. The car wash itself is almost entirely equipment, so you can depreciate the crap out of it and get a pretty big loss. And if that offsets enough income, it kind of reimburses you in a way. So if you buy a car wash for $1 million and they're going for a lot more than $1 million, and you put 35% down, you're putting $35,000 down, then you're assuming you're in the 39 or 37% tax bracket. When it comes to do your taxes, you may depreciate nearly all of the $1 million. And then if you had $1 million of other income, you might have gotten back close to your $35,000 that you put down. So then at that point, you're in a pretty good spot. So that's D for depreciation. Now E is equity. Unless you do something really weird, you are increasing the equity of your asset every year. So your net asset value goes up annually. For shopping centers, you're doing it in two ways. One, you're paying down the principal of the loan that you have. So a lot of the loans for properties that we own are either on a 25-year or a 30-year amortization schedule. So some of the principal gets paid down every mortgage payment. And also in that amortization schedule and those terms are fixed, meaning that we're locking it in for 5 years, 7 years, or even 10 years. So that's contractually locked in, and I can predict it over the next many years. At the same time, I have leases that are long-term with businesses that also have contractual rents. And a lot of times those rents go up annually. So as the rent goes up annually automatically and the principal's getting paid down automatically, you're naturally getting an increase in the equity of your asset. And you just let it happen. You don't have to do a whole lot, then let it happen and operate the property well. So that's E for equity. A is appreciation. The gross asset value of the property goes up in two ways. So E was the net asset value. A, appreciation, I'm talking about gross asset value, right? And so the gross asset value is going up in two ways. Either one or both happen, NOI goes up, cap rate goes down. Let's go talk about NOI, net operating income. So that goes up by increasing the occupancy of your property, going from 70% to 100%, 80% to 90%, et cetera, of occupancy, or decreasing expenses, bringing down either your actual operating expenses per year or your capex cost, which is another type of expense. It's a capital expense. Increasing the rents, maybe it's that for the shopping centers, when you say increasing rents, that's often tied to tenant performance. So if your tenants are doing very well and their sales are very high, then naturally they can afford more rent because they're doing so well. The tenant site selection process is scientific and they spend a lot of time on it. And oftentimes the quality of the site that they selected really dictates how strong their sales are. So if your tenant sales are very strong, they're not going to want to move to another location because maybe they're doing so well because of the location. But there's other ways that you can generate even more sales for the tenant or help them generate potential sales, which is making sure you optimize the tenant mix, meaning that you have the tenants adjacent to them very well paired with each other so that there's synergy there, that the common area is maintained very highly or in a very clean, very secure so that customers feel comfortable visiting the property. Then you do a lot of events and community engagement. We see a very high correlation between community engagement and the success of the tenants of the property, especially if they're retail properties. Now, cap rates can go down, or you can help them bring them down in non-macroeconomic factors when the income of your property is deemed less risky. So let me repeat that again. So the value of your property is through the income, and the chances that you collect all the income, that's the risk. If you're dealing with a lot of national tenants, the thought process is you're going to have a very high likelihood of collecting all the rent. Now, if you're dealing with very low credit tenants, the thought process is there's a chance that you don't collect all the rent. So that is the durability of that income stream or the chance that you're collecting all the rent. And you can show the buyers of the property when you go to sell or when you go to get it appraised that your rents are very likely to be collected and maybe even go up by having better credit tenants, and then checking your tenant ledger and just making sure that it zeroes out every month. If you can show a history that all of your tenants pay the rent by the 5th of the month, that goes a long way. Also, if you collect your tenants' sales reports and show that they're doing extremely well, it tells the investment community, hey, our tenants are doing extremely well and there's no reason for them to move. And even if they could move, they wouldn't move because the real estate's so good. And that's part of the reason why they are doing so well. And then also replaceable rents. So if you own a shopping center in an area that is continuing to improve and maybe the contractual rent increases didn't keep up with the area, meaning the area improved so much, having a market rent of $30 a square foot where your tenant is paying $20 a square foot could be a good thing in that people will put value on that and say, hey, even if the tenant does go out of business and vacates the space, hey, I can backfill that tenant right away. And actually, that's been the case with a lot of these tenants that had gone bankrupt that opened the stores in the 90s or maybe the early 2000s, and they locked in those rents from 30 years ago or 25 years ago, and they're considered below market rents today. And that's A for appreciation. L is for leverage. You can put long-term positive leverage against these properties, and there is a very liquid established credit market for the debt. Most real estate is acquired through some sort of debt, either at the property level, the fund level, or the enterprise level. So even private REITs or public REITs, they're financing them perhaps in a way that's not obvious, not on the property level, but maybe it's on a portfolio level. We do it property by property, so we keep it simple. And for retail shopping centers, there's almost always strong arbitrage between the cost of your debt and the cap rate. So we like to buy in the 8% to 9% cap rates, and the debt cost for us today is about 5.5%. So there's a bit of an arbitrage. And when you put debt onto the property or leverage, I know that some people, or there's a lot of maybe negative sentiment on leverage, but if you pay attention to the debt service coverage ratio and just make sure that you're well above, 1.5 times debt service coverage ratio, then it's really hard to get in trouble. And especially if you have a strong sense that those tenants will be paying the rent on time every time. All right. So to sum it all up, why is commercial real estate such an amazing investment or the ideal investment? From an income standpoint, as I stated, we're getting income through rents. And when you compare that to stocks, not every stock pays dividends. When you compare that to gold and oil, they don't pay dividends. And when you compare it to crypto doesn't pay dividends naturally. You have to do some funky stuff to stake it and things like that for it to pay anything. Depreciation, nothing else does depreciation, only real estate. For equity, when I mentioned building equity through contractual debt, principal pay down, and then contractual rent going up, really, maybe stocks, I don't know, I don't think so. Bonds, definitely not. Gold and oil, no. Crypto, no. And then appreciation, where you're able to appreciate the gross asset value of the property through work that you do, like cap rate compression or NOI growth. I mean, you only have so much, definitely not bonds, not gold, not oil. Those are all kind of more macro affected, definitely not crypto, maybe stocks, right? And leverage onto the ability to put leverage onto the assets. Yeah, you can buy on margin with stocks. Bonds, you're not really leveraging to buy bonds unless it's some like Japanese carry trade or something like that. A gold and oil, I do not suggest leveraging up to buy gold or oil, and certainly not crypto, although I have heard people put crypto on their credit cards before, not suggested. So if you are looking at this over a 10-year horizon and you think that crypto, stocks, bonds, commodities are better than commercial real estate, let me know why and comment below. But I hope you enjoyed this. My name's Hugh Chen. I'm president of Saglo Companies. We own and operate shopping centers across Florida, Georgia, and Maryland. We have about 2.5 million square feet. I've been in the business since the year 2000, so about 25 years as of today. And I started off in retail leasing. I did that for about 12 years. I transitioned into acquisitions and capital markets, and then into operations. I touch pretty much everything in the company now. I am president of the company and oversee all departments.